Hello, everyone. I hope you are doing well. Hi, David. How are you?
Hi, good afternoon from a very grey and miserable London.
Thank you for joining. And for the people that will be joining on the webinar, we are trying to also go live. So if you see some people walking in between, you understand that we're trying to do that as well in the meanwhile. So first of all, I want to introduce David. David is a wine expert. He has his own company and he sources wine for people. And I'm very excited for people to hear more about this. And thank you, David, for joining. You have a lot of experience in this industry. So thank you from joining out of the UK.
Thank you for that, Simon. Good afternoon to everybody. It's lovely to, well, look at that. I can see behind Simon that beautiful blue sky in Dubai, and it's making me very jealous. So, wine investments. Let's get started. I've got a few bits and bobs to show you, but first of all, perhaps a little bit of information on me. So, prior to establishing Amphora Portfolio Management, I was actually a stockbroker. I was working in the City of London, and my journey into wine was kind of as an accidental wine investor, I'll confess. So what happened around that time, being a fairly young stockbroker, being paid more than I'm sure I deserved, it turned a love of wine, a sort of general love of wine, into a love of fine wine. And I would characterize myself at that time, I guess, as a collector. And I was hanging around with other people who collected wine, all of whom were working in the city and the markets with me, and we were having a lovely time drinking these glorious wines, some of the best wines in the world. Now, a very interesting thing happened. Over the course of time, the guys that I was buying this wine from, which were the traditional merchants, those guys were often sending me the wine or they're storing it on my behalf, they started phoning me up and saying, David, mate, can I buy that back from you? And I'll give you 40, 50, 60% more than you paid for it in the first place. Wow. So there's me, a relatively young guy, working in the markets, fascinated with investments, in love with wine, and I'm suddenly presented with information, evidence perhaps, which would suggest that my passion also looked and acted a little bit like an investment. You can only imagine the level to which my interest was piqued. So a group of us, a bunch of us, myself and some other friends, associates, contacts from the markets, we started investigating the wine market in great detail with a view to understanding it. And with the notion, and it was only a notion at that point, with the notion of starting a business that could help other people invest in wine and help them do it that little bit more efficiently, profitably, judiciously, and whatever else. And of course, the fact that I'm talking to you today, and the fact that we're 15 years into Amphora's lifespan tells you that we did find a few things where we thought we could help people, and we did launch the business. And so I would like to show you a little bit about wine investment, why it appealed to me, and what I thought was just gorgeous about the marketplace. So let me just share with you. Let's run this from the start. Simon, are you able to confirm that you can see that for me? I'm hoping that the attendees can see it. Yeah, okay, splendid. Okay, so fine wine investment. I'm going to whiz through this at quite a rate of knots because then my time is yours. You can ask me any questions at the end, and anything that you would like me to put some meat on the bones, I'll be more than glad to do. But the first thing we need to do is frame what we're talking about with regard to fine wine investment. And the first key here is that when you're investing in wine, you're investing in fine wine. Fine wine, now this is a phrase that's bandied around quite a lot, and we need to define it so that we understand what we're talking about. Fine wine, high quality? Sure, in theory. I might challenge that occasionally, but in theory it should be high quality. But in actual fact, there is a technical and very precise definition of what constitutes a fine wine, and that is a wine that improves with age in the bottle. Not many wines do this. Most of the wine that you'll buy in a supermarket, it's ready to drink when it goes into the bottle. It's not going to get any better over time, and that's it. That's its place in the market. But if you go to the very top of you put all the wines in the world into a great big pyramid of increasing quality and desirability and price, presumably, then right at the top you get to the fine wines, and these need time in the bottle to get to their drinking window. And this is going to be quite important as you start to understand what I'm talking about with this particular marketplace. So, just being a fine wine, does that make it investable? Not a chance. There are so many other things that we need in order for a fine wine to qualify as an investment grade wine. We need low volumes. All luxury asset classes, to some degree or other, are predicated on scarcity. I guess it's worth just reflecting here what that means in fine wine terms, because the production methods of fine wine mean that the scarcity is enshrined into the production method. And what I mean by that is that if you're making fancy cars or fancy watches or fancy handbags and your marketplace increases, or a new country starts becoming interested, you can increase your production to satisfy market demand. In the wine market, they can't. Your wine producer will have a certain number of vines, and from that they can produce a certain number of bottles, and there's nothing they can do to make more of it if their product becomes more popular. And in actual fact, in many countries like France and Italy, that's actually enshrined in statute. So there really is nothing they can do to increase volumes. Critical acclaim, we want these things to be wines that are sought after and well thought of. A high price. Now, that's purely a practical matter. You have to store these things and look after them and babysit them for a period of time, and that costs money. To store a case of wine that costs £100 costs about £20 a year. To store, or a case of wine that costs £10,000 costs £20 a year. And one, as your maths will tell you, takes a much bigger chunk out of the profits than the other. Here's the rub, right? This is the most important thing, underlined for a reason. The wine has to have a secondary market. Like any investment, the golden rule is if you can't sell it quickly, you shouldn't invest in it. Well, I suppose unless you do so knowing that it's very illiquid. But in the wine market, you would actually be astonished. I was astonished when I first started investigating this, how few wines actually do enjoy a ready secondary market. How many are, if you'll excuse the pun, liquid? And that has frustratingly narrowed the universe of wines that we look at, but it's a rule that, of course, can't be broken. Now, what that will tend to mean is that from a geographical perspective, most of these wines will come from what we call the old world, which, broadly speaking, are the European producers. Now, the wine market is expanding. It's changing in front of my nose, but in terms of global reach, for the time being, we're really only seeing tradable wines come out of the USA, predominantly from Napa, and some from Australia. Look at that, they're making wines in Australia land and America land, who knew? But as yet, we don't have any wines from South America. We don't have any wines even from New Zealand, South Africa, some winemaking regions that you might be surprised to find absent from the wine investment arena. And it just comes down to that golden rule. They don't currently enjoy a secondary market. We watch them like corks. When they do, we'll add them into the fund. Okay, so the chart that you're seeing in front of you, of course, we're talking about wine investment, so you want to know how it's performed. You're looking at a chart that runs for just over 20 years, and it compares the fine wine market against various stock market indices that will be very familiar to you. And the wine-coloured chart at the top is the Livex Fine Wine 100 Index. It's the industry benchmark. The data is produced by a company called Livex, who are a very important player in the scene, in the wine scene. And this index actually is quoted on Bloomberg and it's quoted on Reuters. It's very well respected. And you can see there that the long-term performance has been incredibly strong against some of the traditional marketplaces. More importantly, this chart tells a story, and it tells quite a cool story. Let me show you. In demonstrating how organic the wine market is and how it reacts to international events. You can't do better than have a look at this. So let's run through this. Around about here, around 2005, you'll see that the market enters a bull run, a broken bull run with a correction in the middle, but one that runs up to sort of 2012. That was the emergence of the Asian markets, most notably Hong Kong and China, piling into the wine market. Prior to this, the wine market was, broadly speaking, was dominated by Europe and North America. And what you're witnessing here is the true globalization of the marketplace, and the legends of what happened in China are now folklore. And away we went. We had this huge bull run, and up to this point where we have a correction, and the eagle-eyed amongst you will be ahead of me. You'll see what's happening here. This is the financial crisis, and we have there an exogenous shock into the marketplace, which has caused a correction. No surprise. Why did it start again back into the bull run around about here? Well, this is interesting, right? Because what happened here is that Hong Kong played a masterstroke, and Hong Kong abolished all import duties and alcohol taxes on fine wine, mindful of their suddenly very important place in the wine trade and how much this stuff was coming from Europe and moving into China or into the Hong Kong marketplace. It really was an incredible foresight from the authorities, because for a brief moment in time, the Hong Kong became the biggest trading hub for fine wine in the world. It's always been London, very closely followed by New York. Again, then the bull run off it goes again, up to about here, and then the fun stops for a little while. And this is when Xi Jinping clamped down on corruption. One of the things that we lost here was that if prior to this, if you wanted to lubricate a business deal or court favor with a government dignitary in China, you turned up with a case of Lafitte Rothschild, and being your deal was done. And so conspicuous gift giving was one of the things that was outruled. Now, it really wasn't a sufficient shock to cause the correction that you can see that followed on for it. But of course, in the Asian markets, the wine market was embryonic and very much based on sentiment, and sentiment fell out of the market, and we had a correction. Okay, closer to modern times. I wonder if anyone spotted what happened here. This is 2016, and something very close to home for me, and I'll reveal what it is. This is when Brexit took place. Why would Brexit have an impact on the wine market, you might very reasonably ask, and I'll tell you. The reason is that, broadly speaking, as mentioned just now, London is the hub of wine trading, and broadly speaking, you'll find that the wine market is denominated in pounds sterling whenever it is quoted on the international marketplaces. Of course, Brexit meant that the pound took a trumping, and all of a sudden buyers in US dollars, in renminbi, in rupees were courting a 15 or 20% discount to the price of it before. So we got a little bit of a bull run, and we got another one here, and that one actually was lockdown. Lockdown was really good for business because, of course, luxury goods were off the table. We couldn't go on holiday, we couldn't show off our fancy watches and our fancy handbags, we couldn't drive our cars, we couldn't even go to restaurants, and one of the things that we could enjoy was fine wine at home. And so we entered into a really quite extraordinary bull run, about 32, 33 months of unbroken growth as demand soared, and not just as demand soared, but as people upgraded their buying decisions, spent a little bit more on each bottle. And you'll see at the tail end of this that we've had a correction over the course of 2023, and I'll talk to you a little bit more about current market conditions towards the end of the presentation. Okay, moving on. Thinking back now, as a younger David Jackson, stockbroker, really interested in this, mooting starting a business, I started to look into it in detail, and I unearthed some really unique characteristics that underpinned fine wine as an investment. And one of these was the supply-demand dynamic. Now, I know that all physical asset classes are predominated on supply and demand, but I think that you will find that the one in wine is quite unique. Let's just do this as a very simple rudimentary chart. So if we were to run time against supply for any given wine, so let's say at the time that we launched this business was 2009, so a wine that we might have been interested in would have been Lafitte Rothschild 2009. It would have come to market with something like 20,000 bottles for the international marketplace, and then over time, this would have happened. We would have had diminishing supply to market, and the reason for that, again, some of you will be ahead of me, the reason is that people are putting the corks out and drinking these things. Now, this is important. I will challenge you in your own time to have a think about any other physical asset class that has this characteristic, that by the natural course of events, it will have an inverted supply curve. It's hard, there aren't very many. Short of one of the 16 owners of 250 GTOs wrapping one around a tree, God forbid, it doesn't happen in other asset classes. And this is a reflection. You often hear me say that wine, in fact, is the ultimate luxury good. And the reason I say that is that you get to use it once. And you can only imagine that, you know, every time you bought a new shiny watch and then you had to smash it with a hammer after the first wear or throw away the handbag or whatever else it was, we might think twice about buying these goods. Now, we're going to come back to this supply-demand dynamic because it's important. It's against this backdrop of limited production. You have this diminishing supply to market. You have increasing demand over time. Now, this is not only from the globalization of fine wine, which we've seen, although that is very important. This, again, is a natural characteristic of fine wine. Remember, it improves with time in the bottle. The really fine wines, the top 1%, the top 0.1%, let's say, of wines that will populate a wine investment portfolio will take a decade or maybe more to reach their drinking window. So they're improving in quality over time, getting closer to being drunk. You get natural increasing demand. This is schoolboy economics. This will put pressure on the underlying price of the asset classes, and you will see prices increase over time. This is why my portfolio, as a rookie, as an unintentional accidental wine investor, started to go up in value. If you buy the right wines and you hang on long enough, you're going to make money out of these bottles. My purpose is to help people do it a little bit better. So we should perhaps talk a little bit about that. And again, another characteristic that I thought I could help people with this is that it is like a stock market. You've got hundreds of producers. You've got numerous regions, which you'll find me applying, often applying investment terminology. I talk about geographical regions as sectors. They are sectors. Multiple vintages. A vintage, in this parlance, for anyone who doesn't know, is simply the year of production. That's what a vintage is. It doesn't mean that it's old. And each vintage, from an investment perspective, is unique because the climatic conditions will produce wines of different qualities, even from the same producers, and that will have a different impact in the marketplaces. And that is a little mini stock market in anybody's parlance. So we took this stock market, and a group of us got together, some of us stockbrokers, some of us wearing quite big pants in the financial markets. One of my associates established the first global emerging markets platform for Deutsche Bank. We've got a guy from Merrill's who used to build very complicated quants, who now builds our analysis tools. And we came together. Our goal was to create outperformance from people's portfolios compared to what was happening with the traditional advice that was coming from merchants. A bugbear of mine. Merchants are people who know more about wine than you and I could ever care to know, but they don't understand the investment process, and therefore their advice was at best clumsy, anecdotal, wet finger in the air, and sometimes I would say self-serving. And in order to do this, we have developed some quantitative analysis tools. This was hard. When we first sat down and put our heads together, we were drawing blanks for the longest time because we were saying, well, hang on, look, there's nothing to hang your hat on. This is a drink. There are no fundamentals. There's no cash being thrown off. We can't create PE ratios. What do we do? So we thought long and hard about this. And in the end, we settled on developing a quant that would enable us to model the market on a relative value basis. This, again, is very important. I think we were the only player in the marketplace to have a quant of this sort 15 years ago. I'm of a mind to say we're the only people that have got one now, which astonishes me. Our information is in the public domain. We've given people a blueprint as to how to make one. But we wanted to understand how and why wines are priced. Why is a case of 2005 Petrus £40,000, whereas a case of 2007 Duhat Milan is £700? And what does that pricing mean to their investment potential? And does it mean anything at all? And so we started to build this analysis tool over time. We started to backtest it and backtest it and backtest it. And I'd like to give you a very simple illustration of what we've been trying to achieve with this quant. So this is a random selection of vintages running from 2001 to 2013 for a little wine called Lafite Rothschild. Any of you who love wine, of course, heard of it. It's one of the finest and most desirable wines in the world. And when commentators view the marketplace, you'll hear them talking about on vintages and off vintages. And all that means is that the on vintages are the best ones, where the climatic conditions came together to make the finest wines, and the off vintages are the ones where it was more challenging for whatever reason, frosts and lack of sun and all the rest of it. And if we're to look at Lafite Rothschild over these vintages, the red towers are the on vintages. They're the humdingers. They're the ones where everything came together, and the better wines were produced. And you can see against the legend on the left that they're the more expensive wines, and that's as you would expect. And if we were to overlay the quality of these wines, the legend, I don't think you can see the legend on the right, but those blue dots represent points out of 100 amalgamated from the critics. And again, you can see that there's a tendency for the price to follow the quality. This kind of is what we would expect. Now, the challenge here is, what vintage do you invest in? Because if the 2003 and the 2005 are better quality, but they're at a higher price, how do we know whether the quality is already fully built into the price? Are the best vintages the best investments? And the answer is probably and often no. And I think you can see, if you have a glimpse at 2001, you can see that the little blue bubble is way floating above it, and that might look like it's a good buy. And what our algorithm does, in fact, is exactly this. It takes all of the determinants of price, not just quality, but all of the other things that are important, weights them according to their importance on setting price, and then divides them against the price. And if we were to divide this, the quality against the price, then you would get a different set of towers showing you which ones were the best to buy. And I hope that makes sense. I'm glad to talk about it later for those who are sort of scratching their heads going, hang on, what on earth has he just talked about? But we apply this across the entire marketplace, and we apply this data to over 100 different properties, over 20 vintages. And so our algorithm built as a model of the marketplace on a relative value basis by way of towers. If the market were efficient, then all of those towers were absolutely efficient. If it were in stock market terms where information flows, then those towers would be more or less the same height. In the stock market and in the wine world, we enjoy inefficiencies. It's where we find the opportunities. It's not as inefficient as I had hoped. And for anyone interested, I can tell you about that. If anyone's interested in the Q&A, remind me to tell you about why merchants are market makers without knowing what a market maker is. But what this enables us to do is it enables us to lower the number of wines that we're looking to analyze qualitatively. It has to be a qualitative overview because wine's touchy-feely. It needs a human touch before we can make an assessment. But this enables us as a small team to have a closer look at where we think the right opportunities are. We've engineered some serious outperformance over the years using this approach, which I still think is a unique approach in our marketplace. Okay, so you're probably starting to understand why I was enthusing about this and why I set the business up in the first place. The screen that you're looking at in front of you is our warehouse, and this will move me on to a very different, but I guess equally important topic, and that's about how and where you should store your bottles, whether you invest through us, I hope you do, or whether you invest on your own endeavors, in which I wish you the very best of luck. You should store your bottles in a bonded warehouse, and you should store them in the UK. Now, you can see there are a lot of wooden boxes, and each of those boxes contains 12 or 6 bottles, occasionally 3 bottles. They are unbroken, unopened. That's how the market trades. It trades in cases, not in single loose bottles, and certainly not in bottles that have been removed from bond. And I'll talk to you a little about the advantages of keeping your wine in a bonded warehouse. So our warehouse is a UK government modeled warehouse. It's a highly regulated environment. It's all in the correct climatic conditions, air conditioned, and the wines in there are fully insured, as you would expect. Now, wines that are stored in this bonded warehouse are very important to us as portfolio managers. They mean that we can guarantee, or to all intents and purposes, we can guarantee authenticity, provenance, and condition. And the importance of that is that it makes it incredibly straightforward for us to resell those bottles on the international marketplace at the end of the investment term. And that's part of the service that we provide for our investors. Wines that are taken out of bonded warehouse and taken home are notoriously difficult to sell, and in fact are considerably less valuable. So store your wines in a bonded warehouse. However you invest in fine wine, store your wines in a bonded warehouse, and preferably store your wines in a bonded warehouse in London. Okay, so a little bit about what we actually do. So if any of you are interested in having a deeper dive into this and would be tempted to have a play on the marketplace, we would build a portfolio for you, a bespoke portfolio, and this would be based on the current market conditions. It would be weighted to reflect the sentiment in the marketplace from a sectoral perspective. If you recall, when I'm talking about sectors, I'm talking about geographical regions, and then we would use the algorithm to pinpoint where the best opportunities lay at any given moment in time to populate it with the specific wines that would go into your portfolio. When you buy that portfolio, legal title passes to yours. We may be babysitting in our warehouse for you, but you're the owner. You have good legal titles. And you can take them home and drink them if you want them, but from this perspective, we're talking about them as an investment, of course. This is a fully managed portfolio. We will give you your buy-to-hold assets. There would be regular oversight on your portfolio, so we would reweight it, do a bit of buying and selling, a bit of switching, crystallize profits where they need to be crystallized, put our hands up and say one isn't working, get rid of it and get that money working better elsewhere. We provide you with all sorts of different opportunities over time, and at the end of that term, we would sell those wines for you, meaning that you can enter the marketplace as a complete novice, or you can enter the marketplace even if you know a little bit about wine and you can capitalize on our very specialized area of knowledge. So I think that's probably enough for me for now. I'll pass the reins back to Simon and open myself up for any Q&A.
Yes, David, that was very informative. Thank you so much for sharing this. There are some questions that have been asked, which I want to ask you. The first one is, I did see that you touched based on this, but maybe you can repeat this. What kind of returns can investors expect?
So our ambition is to always get double-digit returns into a portfolio, which we're pretty successful at doing. One of the challenges, of course, in documenting our performance is that there's no AM for a portfolio, because each of our clients has their own portfolio with a different agenda, and it's very difficult to show what their performance is. But what we did do is we set up a sample portfolio that we run and we publish in the public domain, and that's been running consistently in double-digit figures. Before the correction that happened from the start of 2023, we were actually running just over 12%, but that's taken us down to 10 and a fraction %. So those are realistic ambitions to be in that sort of 10 to 12% per annum territory.
Yeah, okay. One question was asked about the liquidity. You did share more information about it in one of the beginning slides. So just to confirm, this is not something that you are locked in for. If you want to exit, how does it typically work? Like the worst case scenario.
Okay, yeah. So you're not locked in. You're not locked in at all. You can sell whenever you want to sell. The liquidity is pretty good. It's better than I think most people would expect. It's not stocks and shares good, but it's certainly better than property and classic cars and all that sort of stuff. So in practical terms, when one of our clients wants to sell, we will go to market in a sense. So we'll offer that to our international buying network, and we'll draw in the bids over about 28 to 48 hours. So we can actually lock in the sale price, the guaranteed sale price within 48 hours. So the seller will know exactly what they're going to get into their bank account within 48 hours. There are then practicalities, which are the mechanics of selling wine. They have to change bonded warehouse, they have to be delivered and inspected at the new warehouse. Even if they don't change warehouse, and it's only names on a computer screen that change, the process is still the same, because the new ownership has to be registered with HMRC for tax and all that sort of stuff. So money into bank is 4 to 6 weeks. Four in the normal course of business, 6 when when things are going. Not bad.
That's pretty fast, faster than I thought. So that's good. And another question asked is, how big is this market? Do you know in terms of like millions or billions or trillions?
It's tiny. It's absolutely tiny. We calculate that small section of the area that we're in, which is the secondary market of the top 0.1% of wines in the world. So these are the wines that are retraded and resold several times. We calculate that to be about $6.5 to $7 billion US annually, which as a market is incredibly small. I think that just that volume of just gold is traded just in London weekly. So that puts it into context for you.
Okay. And who are the main buyers and sellers? Where are they from?
So okay, there's two answers to that question. So of course the people who are wine investors or collectors or temporary custodians of the wine for whatever reason are private individuals. And of course, it's that really unusual dynamic. I love this, that because it takes wine 10, 15 years to mature, the market had to develop a mechanism for these wines to be babysat without suppliers, producers, merchants having to have extraordinarily long ownership time before they could bring their product to market, impossibly long. And that's where the wine investor comes in. So I would argue that even those that have a notion to drink it at the end of the 10 years or think of themselves as collectors, they're still wine investors. So these are private individuals. Those private individuals will predominantly still be in Europe and in North America, but the Asian markets these days are incredibly important. We've seen a downturn in the Asian markets, over recent years for all the obvious reasons with the Hong Kong troubles and all that sort of stuff. So this sits in private portfolios and bonded warehouses around the world with private ownership from Europeans, North Americans, and to some degree Asians. The big players in the marketplace from a trade perspective, this bugbear of mine, it's the merchant. The merchants control the price. You remember I mentioned that merchants act as market makers. I think this is actually sort of quite important for anybody who's involved in markets. They'll be fascinated by this, because young wine, and when in this wine, this sort of again at the top of the pyramid, we're still talking about these wines being young up to about 20 years old, and up until about 20 years, the condition between one case of wine and another one hasn't changed to any material, to any significant amount. So one case of Lafite 2010 is much like any other case of Lafite 2010. So you have a fungible product. You've got a fungible product that's traded in a secondary marketplace, and that secondary marketplace has published prices. There's even a price comparison website called Wine Searcher, and all of the merchants publish their prices on there, and they're trying to buy and manage their inventory from private buyers. So they're trying to buy and sell their inventory based on their sentiment and their expectation of what they're able to sell in the market, competing with others with visible prices. That's a market making system. And that's brilliant, because it means that we can nail the market from an offer price perspective. And I absolutely adore that. What I don't adore and what I have a problem with is that it means that because the merchants control the price, they've often controlled the marketplace, because people will go to the merchants for investment advice, and they're not getting good advice at all. They're getting well-meaning advice, and they're not getting it's as honest as the merchants are able to be, but it's the wrong advice. So from a commercial perspective, the players that are controlling the marketplace are the major merchants, and particularly those ones which will have over 100 million US of stock at any time, which are people like Berry Brothers and Farfigers and Bordeaux Index and all of those.
Yeah, great. And another question I got was, how correlated is it with the stock market?
So, okay, more than I like in the modern world. So I think that one of the benefits that was historically touted around about wine investment was that it is uncorrelated to the stock markets. I think that we've seen that effect less and less over recent years. And I mean, man, yeah, it's the modern world. Everything's interrelated. And of course, fine wine, luxury goods prices are interrelated to international wealth. And international wealth is related to stock market success. So there is some correlation. It's not entirely correlated. And I think that what's quite interesting about the wine market is that it's, you know, it's really sentiment based. And you have marketplaces, you know, the big noise in the marketplace at the moment is India, a really important player in the marketplace. And boy, is that sentiment-driven market. And so we have a lot of how people are feeling and taking sort of a long-term view. And so when you have the sort of traditional markets looking 6 months in advance and saying, well, we're sort of comfortable, you know, if we take 2024, the traditional markets are all sort of a view that anything that comes out of the blue will be an exogenous shock. You know, people expecting interest rates to come down, all this sort of stuff, a general sort of a general more bullish sense, and that will feed through in sentiment in various marketplaces. So, in short, I would say you need to sort of watch what's happening on an international perspective, but more you need to have a view as to what's happening in terms of sentiment. And another point as well is if you remember that chart and the little circles that I was drawing and showing you how organic the marketplace is, and certain things will have an impact on the marketplace. You know, we had a shock in 2019 when Donald Trump put taxes on European wines. He did it as a tit for tat because he thought that Airbus were up to dodgy dealings to the detriment of Boeing. You know, these sort of things come out of the blue and have an impact on wine.
Yeah, great. Yeah, and it makes sense that it's becoming more correlated with the stock market. I mean, I understand what you mean, that it's becoming more and more like that. But that to dive into the details why that is the case, maybe we can park that for another time. I got another question about, like, what is the ticket size? What is the amount that people tend to invest in wine, and how much of a proportion of their wealth do they allocate into this?
Yeah, okay, so there are practical, as a business, we don't set a minimum quite deliberately because we don't want to scare people off who are coming to the market, you know, and have never looked at it before. But there are practicalities. The sort of wines that you're investing in are expensive by definition, and one of the great benefits of the market is that broad depth and breadth. You know, the opportunities for diversification. Of course, we really want to take advantage of that. So I would suggest, in practical terms, that about $25,000 is really about the minimum that someone should look at. I would say that typical ticket sizes that we deal with are they tend to be multiples of 50,000. A normal portfolio would be either 50,000 or 100,000 US dollars. Those that are starting at the sort of $25,000, and that's great. We can do magic things with that. We can get some really great diversification, and it makes for a wonderful portfolio. We're keener on taking on those portfolies for people that are of a mind to adding to it over the course of time. In fact, let me put it into context. So we talked. I mentioned a wine called Lafite Rothschild several times. A case of Lafite Rothschild will tend to cost anywhere from $7,000 to $10,000 US dollars for a case of 12 bottles. Now, you can't stick that into a $20,000 portfolio because straight away you've polarized it. So you see the problem. And that's not to say that those portfolios can't be built as wondrous things. They can, but you see the problem. So as these sizes increase, we can do better things with portfolios.
Yes, and just to summarize that as well, like the more you invest, I mean, the more money you make available, the more you can diversify, and the better options you can select for the clients. Of course, you know, you should not put all your money in it, but yeah, if you want to make good returns.
It's one of those sort of slightly counterintuitive ones that if people lower their investment amount too much, they send their risk profile through the roof. And you know, if you can imagine, if somebody bought one case of wine to dip their toe into the marketplace. Really, all they've done is they've taken a punt. And their view of the marketplace will depend on that single case of wine. If it rockets in value, they think wine investment's the best thing since slicing bread. And if it sits there like a dumpling for the next 2 years, they'll go, what a load of rubbish, I don't want to do it again. And so we try and avoid getting people into those sort of cycles and that sort of mindset as best we can.
Yeah, that perfectly makes sense. I have one final question that I received is, how do I know what to buy and what to sell?
Oh, well, we'll advise you on that, absolutely. So we will hold someone's hand every step of the way. I wouldn't suggest to you that all of our clients, by any stretch of the imagination, are all wine lovers, and I would suggest that a relatively small proportion of them are wine experts. And so we'll have a consultation with people and understand a bit about them and how this looks within their overall scheme of things, and we will produce a portfolio made specifically for them and to represent their risk profile and all that sort of stuff. And we will then keep an eye on that, and we'll tell them exactly what to sell and when to sell it, and arrange the sales on their behalf. And that's important, because I think that for somebody to enter this market and to go it alone, I mean, I think bravo, go for it, but you need to sort of think about how you're going to go about it. You need to develop a strategy, because even though we're only interested in about 100 producers, many of those will make more than one wine. So we might have 200 wines that we're interested in, and if you look at those over 20 different vintages, straight away you've got 4,000 opportunities. And so you've got to have some sort of arbiter of relative value, or some sort of methodology that cuts away all of the stuff that you don't want and drills you down into the stuff that you do want. But of course, that's what we're in business for. That's what we do.
Excellent. So for the people that are listening live, at the end of the session, you will have some questions that we will ask you, including like if you have invested in wine before and if you are interested to explore this further. For the people that are watching the recording later that have registered, if you're interested to know more, please reach out to David or to me, and then I will connect you with David. David went through the questions. I want to thank you so much for sharing your knowledge. Clearly, you have a lot of expertise, experience, and knowledge about this. That is very clear. David Jackson is the director of Amphora, and you can hear a little bit of a snapshot about how much he knows. But if you want to connect with him directly, we can arrange that. David, thank you so much for joining.
Oh, that's my pleasure. That's my pleasure, my friend. I hope it was enlightening for folks, and well, I hope that I get to connect with some of you in person and talk about the red stuff in person.
Yeah, that sounds good, and I will definitely reach out to you, and we have a recording available, so that makes it also easier for the people that did not attend and for future people to watch back and to learn more about this exciting asset class. Thank you again, David.
Good stuff.
For joining us all the way from the UK.
Okay, cheers. Bye-bye for now.
Bye-bye, David. Bye-bye, everybody.